There's a question human beings have been asking for as long as money has existed, and the answer reveals something uncomfortable about the architecture of our minds. Why do we keep falling for schemes that promise instant wealth, even when we know the odds are stacked against us? Why does the lottery player, the day trader, the cryptocurrency enthusiast, the multi-level marketing recruit all share the same gleam of certainty in their eyes, the same conviction that this time will be different? The answer isn't stupidity. It isn't even greed. Exactly. It's something far more fundamental to what it means to be human. And understanding it requires us to trace a thread through centuries of financial catastrophe, across cultures and economic systems, into the very wiring of our brains. Picture a Dutch merchant in 1637, standing in a crowded tavern, mortgaging his house to buy a single tulip bulb. Picture Isaac Newton in 1720, one of history's greatest minds, watching his fortune evaporate in the South Sea, bubble, and admitting he could calculate the motions of heavenly bodies, but not the madness of men. Picture a Russian grandmother in the 1990s, handing over her life savings to a pyramid scheme that promised returns no legitimate investment could deliver. Picture a young professional in 2021, quitting her stable job to trade NFTs that would be worthless within months. These people share nothing in common except time and circumstance, yet they all fell into the same trap. The details change. The technology evolves. The wrapping gets more sophisticated. But the fundamental mechanism remains identical across 4 centuries, and it tells us something profound about the gap between how we think we make decisions and how we actually do. The story always begins with a moment of possibility. Someone sees an opportunity that seems to break the normal rules, a shortcut through the tedious grind of ordinary wealth accumulation. In the Netherlands of the 1630s, that shortcut was flowers. Tulips had been introduced from the Ottoman Empire and became status symbols among the wealthy. As demand grew, prices rose. As prices rose, more people wanted and soon, traders weren't buying tulips to plant in their gardens. They were buying futures contracts on bulbs that hadn't even bloomed yet, sometimes changing hands a dozen times before anyone actually took possession of the flower. At the peak, a single Semper Augustus bulb could trade for more than 10 times the annual income of a skilled craftsman. Then, in February 1637, the market collapsed. There was no dramatic news, no obvious trigger. People simply stopped believing the story they'd been telling themselves, and prices fell by 99% in a matter of weeks. The South Sea bubble followed a similar arc, but on a much larger scale. The South Sea Company was granted a monopoly on trade with South America in exchange for assuming Britain's national debt. The actual trading prospects were limited. Spain controlled most of South America and wasn't interested in sharing. But the company's directors understood something crucial about human psychology. They didn't need real profits. They needed a compelling narrative and rising stock prices. They got both. Shares that started at £100 reached £1,000 within months. Everyone from washerwomen to aristocrats mortgaged their futures to get in. Isaac Newton himself invested early, made a profit, withdrew, then couldn't bear watching others get richer and reinvested at the peak, losing the equivalent of millions in today's currency. When the bubble burst, it nearly brought down the British economy. Parliament investigated, directors were punished. Laws were passed. None of it prevented the next bubble. In France, around the same time, a Scottish economist named John Law convinced the regent to let him experiment with paper money. His Mississippi Company promised incredible returns from French colonial holdings in Louisiana. Law understood the power of liquidity and credit in ways that were genuinely ahead of his time, but he also understood how to manipulate hope. Share prices soared. The word millionaire was invented to describe those who profited. The entire French monetary system became entangled with laws, schemes. When it collapsed, the resulting chaos contributed to the economic grievances that would eventually feed the French Revolution. 3 different countries, 3 different schemes, all within a few decades, all following the same pattern of euphoria and catastrophe. The pattern continued. In the 1840s, Britain experienced railway mania. The technology was real. Railways genuinely transformed the economy, but speculation outpaced any realistic assessment of returns. Companies formed to build lines that made no economic sense. Investors bought shares in ventures they never researched. The crash that followed wiped out fortunes and demonstrated something historians would see again and again. Even when the underlying technology is revolutionary, even when genuine wealth is being created, the human tendency to extrapolate present trends infinitely into the future creates bubbles that must eventually burst. What drives this repetition? Why don't we learn? The answer lies partly in biology. Our brains evolved in environments where immediate rewards genuinely were more valuable than distant ones. If you were a hunter-gatherer and found a cache of food, eating it now made more sense than saving it for a future that might never come. Your descendants inherited brains that heavily discount future rewards in favor of immediate ones. This is called hyperbolic discounting, and it's why we struggle with retirement savings but gamble on lottery tickets. The lottery offers a tiny chance of an enormous immediate reward. Retirement savings offer a high probability of a modest reward decades away. Rationally, the retirement account is obviously better. Neurologically, the lottery ticket lights up our reward systems far more intensely. The neuroscience is remarkably clear on this. Brain imaging studies show that gamblers and day traders activate the same neural pathways when anticipating wins. The anticipation itself, the moment before you know the outcome, produces a dopamine spike. This matters because it means the pleasure isn't really in winning, it's in the possibility of winning. This is why people continue playing even when they're losing overall. Each near miss, each almost win, delivers another hit of anticipatory pleasure. The brain treats a near miss almost identically to an actual win. You see this in slot machines, where near misses are deliberately engineered into the algorithm. You see it in day trading, where the platform celebrates your wins with confetti animations, but quietly logs your losses in a spreadsheet. You probably won't check. Psychologists Daniel Kahneman and Amos Tversky mapped this terrain in their prospect theory work. They demonstrated that humans are loss-averse when it comes to protecting what we have, but risk-seeking when we're in the domain of gains. This creates a peculiar asymmetry. We'll take enormous risks for the possibility of wealth, but once we have money, we become conservative about protecting it. This is why the poor person buys lottery tickets while the rich person hires wealth managers. It's not that they're differently rational. They're operating in different psychological domains. The poor person sees gambling as a potential gain from a baseline of scarcity. The rich person sees everything as potential loss from a baseline of security. Both are behaving exactly as the model predicts, but the outcomes reinforce existing inequality. Understanding this biology is crucial, but it raises a difficult question. If everyone's brain is wired this way, why doesn't every scheme find victims in equal measure? Why do some people resist while others mortgage their houses for tulip bulbs? The answer is that raw biological vulnerability is only the first ingredient. The schemes that really work, the ones that scale from individual delusion to mass mania, are those that add systematic psychological exploitation to biological tendency. Consider Charles Ponzi, the man whose name became synonymous with a particular kind of fraud. In 1920, Ponzi claimed he could make massive returns by exploiting price differences in international postal reply coupons. The actual mechanism didn't matter. Almost nobody understood it, and those who did quickly realized it couldn't possibly scale to the returns Ponzi promised. What mattered was the social proof. Early investors received remarkable returns. Just as promised, they told their friends invested. They got returns too. Money poured in. Ponzi wasn't investing in anything. He was using new investor money to pay old investors, a structure that works perfectly until the flow of new money slows. When it collapsed, thousands lost their savings. Ponzi went to prison. The scheme was exposed and analyzed and taught as a cautionary tale. Yet a century later, Bernie Madoff ran essentially the identical structure and fooled sophisticated investors, financial professionals, even regulators, for decades. How did Madoff do it? He understood that the Ponzi structure itself, while fraudulent, isn't the hard part. Anyone can promise high returns and pay early investors with later money. The hard part is building credibility that sustains the flow of new investment long enough to get truly rich before the collapse. Madoff had been a legitimate trader. He'd served as chairman of NASDAQ. He had credentials, connections, respectability. More importantly, he understood exclusivity. He didn't advertise. He turned people away. Getting into Madoff's fund felt like joining a club. people bragged about being allowed to invest with him, this leveraged multiple psychological principles simultaneously. First, authority bias. We're wired to trust credentialed experts, and Madoff had every credential. Second, social proof. If successful people you respect are doing something, it must be legitimate. Third, artificial scarcity. We value what's rare and hard to obtain. Fourth, confirmation bias. Once you've invested, you become motivated to find information that confirms your choice was wise and to ignore information suggesting otherwise. Madoff's investors received statements showing steady returns, around 10% annually, not the flashy promises that often signal fraud. This restraint made the lie believable. People showed their statements to friends who wanted in, who showed their desire to other friends, creating a self-reinforcing cycle. When the financial crisis of 2008 created redemption requests Madoff couldn't meet, the scheme collapsed, revealing $65 billion in claimed assets were actually fraudulent. The psychological tactics are remarkably consistent across different schemes in different eras. Anchoring works by establishing a reference point that shapes all subsequent judgments. If someone shows you returns of 50% and then offers you 20%, the 20 feels conservative, even though it's still absurdly high. The initial number anchors your expectations. The sunk cost fallacy exploits our inability to walk away from investments we've already made. Gamblers talk about being pot committed. Multi-level marketing recruits buy more inventory to prove their previous purchases weren't a mistake. Each additional investment makes leaving psychologically harder because departure means admitting everything was a waste. In-group dynamics create powerful pressure. Multi-level marketing schemes are particularly effective at this. They don't just recruit you, they recruit your social circle. Your upline becomes your mentor, your downline becomes your team, your fellow recruits become your friends. Leaving means losing your community. Your success becomes evidence of the system's legitimacy. Your failure becomes evidence of your insufficient effort. The scheme becomes unfalsifiable. If it works, the scheme is validated. If it doesn't work, you didn't work hard enough. This structure makes it resistant to counter-evidence and creates enormous psychological pressure to continue believing even in the face of mounting losses. These psychological principles are universal, but their effectiveness varies by cultural and economic context. Albania, in 1997, provides perhaps the most extreme example. After decades of communist rule, Albania's had little experience with market economics and no trust in government institutions. When pyramid schemes appeared promising impossible returns, 2/3 of the population invested. The schemes weren't subtle. They offered returns that couldn't possibly be legitimate. But they were run by people connected to the government, which gave them an air of official sanction. They advertised openly. They became woven into the economy. When they collapsed, Albania lost nearly half its GDP in a matter of months. The government fell. Riots erupted. Parts of the country descended into anarchy. The crisis demonstrated how financial delusion can become systemic when it operates in an environment of institutional distrust and economic desperation. Russia in the 1990s saw a similar dynamic with the pyramid scheme. Post-Soviet collapse had destroyed savings, destabilized the economy, and created both desperation and a Wild West capitalism where anything seemed possible. Recruited 10 million people with advertising that was remarkably explicit about being a pyramid. The founder, Sergei Mavrodi, appeared in television ads, essentially admitting the structure while framing it as a populist movement against corrupt banks. People invested anyway, partly from desperation, partly from a sense that the entire economy was already a gamble, so they might as well play. The scheme's collapse caused widespread hardship, but also a strange cultural memory. Mavrodi later exported the model to other developing economies, finding willing participants who knew his history but hoped they could get in and out before the inevitable collapse. China's peer-to-peer lending crisis between 2015 and 2019 took the fundamental dynamics and scaled them through technology. Platforms claimed to connect borrowers and lenders, but many were Ponzi schemes using new investment to pay old investors. The scale was enormous, over $115 billion in losses affecting millions of people. The cultural context mattered. Chinese savings rates are high, but traditional investment options are limited. Property had become expensive and restricted. The stock market was volatile. P2P lending promised better returns than banks with what looked like legitimate business models. Trust in technology ran high. The platforms used sophisticated apps, professional marketing, and celebrity endorsements. When the schemes collapsed, protests erupted. The government struggled to respond. Some platform executives fled the country. Others were arrested. Investors lost savings they'd accumulated over lifetimes. These international examples demonstrate something crucial. Financial delusion isn't evenly distributed. It clusters in particular contexts. Economic instability amplifies vulnerability. Institutional distrust makes official warnings ineffective. Cultural factors shape participation patterns. In collectivist societies, where family obligations run deep and social networks are dense, schemes spread more rapidly through community connections. In individualist societies, the framing shifts to personal achievement and independence, but the underlying psychology remains the same. Whether it's Albanian villagers pooling extended family savings or American professionals day trading alone in home offices, the core dynamic of hope overriding evidence repeats itself. But acknowledging cultural variation raises a deeper question. These schemes exploit our psychology and our circumstances, but why are we so desperate to believe in the first place? Why is the audience for impossible promises so large and so persistent? To answer that, we need to look at the economic architecture that creates both the need and the market for get-rich-quick thinking. There's a promise many people in developed economies grew up believing. If you work hard, get an education, and play by the rules, you'll achieve security and prosperity. Your life will be better than your parents' lives. Your children's lives will be better than yours. This was never universally true. It always depended enormously on your starting position. But for a few decades in the mid-20th century, particularly in places like the United States, it felt achievable for a substantial portion of the population. Then, something changed. The change is visible in the data. After World War II, productivity and wages rose together. When workers produced more, they earned more. This created a self-reinforcing cycle of prosperity. People earned enough to buy houses, which created demand for construction, which created jobs, which sustained wages. Around 1973, this coupling broke. Productivity continued rising, but wages stagnated. The wealth that workers created increasingly flowed to capital owners rather than labor. This wasn't a natural development. It was the result of specific policy choices, weakened unions, tax changes, deregulation, but the effect was profound. The implicit social contract that hard work leads to prosperity began to fracture. Housing provides the clearest illustration. In 1970, the median home price in the United States was roughly twice the median household income. By 2020, it was more than 5 times. Education followed a similar trajectory. A generation ago, you could work a summer job and pay a substantial portion of college tuition. Today, that same summer job might cover textbooks. Student debt has become normal, expected, a burden carried into middle age. The promise was that education was an investment that would pay returns through higher earnings. For many, the returns haven't materialized while the debt remains. The gig economy represents both symptom and adaptation. When stable employment becomes scarce, people cobble together income from multiple sources. This gets reframed as entrepreneurship and flexibility. And for some, it genuinely is. But for many, it's precarity with better marketing. Hustle culture emerges not from ambition, but from necessity. You don't have one job with benefits and security. You have 3 apps that might deactivate your account tomorrow. This creates an environment where get-rich-quick schemes feel less like irrational gambling and more like reasonable attempts to escape a treadmill that's accelerating while moving backward. The middle-class squeeze operates through multiple mechanisms simultaneously. Housing costs rise, healthcare costs rise, childcare costs rise, education costs rise, wages stagnate, savings become impossible. The future that seemed guaranteed to previous generations feels increasingly unattainable. This isn't a perception problem. The data confirms it. Social mobility has declined. The likelihood that a child will earn more than their parents has dropped dramatically. Geographic concentration of opportunity means that prosperity clusters in expensive cities while vast regions stagnate. The old pathway, study hard, work hard, succeed, has narrow and often requires family wealth to even access. Into this environment comes the visibility of extreme wealth. Social media ensures constant exposure to people living lives that seem impossibly luxurious. Instagram influencers pose on yachts, Cryptocurrency millionaires share their trading screens. Self-made billionaires give interviews explaining their success. The message, whether intentional or not, is that extraordinary wealth is achievable if you're smart enough, or bold enough, or dedicated enough. This creates what psychologists call relative deprivation. The gap between what you have and what you see others having generates profound dissatisfaction. The $20,000 salary that might feel adequate in isolation feels like poverty when you're constantly exposed to $100,000 watches and million-dollar homes. Economist Thomas Piketty mapped this dynamic in his work on capital accumulation. His finding, expressed as R greater than G, meaning the return on capital exceeds the rate of economic growth, has profound implications. If you already have wealth, it grows faster than the overall economy. If you depend on labor for income, you fall further behind. Wealth inequality isn't a temporary aberration that market forces will correct. It's a structural feature that compounds over time. Inheritance matters more than merit. Where you start matters more than how hard you work. This isn't how the system is supposed to work according to the narratives we're told, but it's increasingly how it does work. The cultural response to this reality varies. American mythology is deeply invested in the rags-to-riches narrative. The self-made man, the entrepreneur, who started with nothing and built an empire. These stories are foundational to national identity. They're true, some people do accomplish remarkable ascents, but they're rare enough to be notable. For every success story, thousands of equally talented and hardworking people remain where they started. The mythology obscures this. It suggests that if you're not succeeding, you're not trying hard enough. This is psychologically useful for maintaining faith in the system, but it's factually incomplete. The prosperity gospel takes this further by adding theological justification. In this framework, wealth isn't just possible through hard work. It's a sign of divine favor. God wants you to be rich. If you're not rich, you're not faithful enough. This creates enormous psychological pressure and provides perfect insulation against evidence. If the scheme fails, it's because your faith was insufficient, not because the scheme was fraudulent. This belief structure is particularly prevalent in the United States, but has spread globally, often through megachurches and televangelism. The self-help industry operates on similar principles with secular language. The problem is your mindset. Your limiting beliefs are holding you back. You need to want it badly enough. Visualize your success. Manifest abundance. This framework has the advantage of feeling empowering while being If you succeed, the mindset worked. If you fail, your mindset wasn't right. The structural factors, the economic realities, the statistical probabilities all get waved away as excuses. This isn't to say mindset is irrelevant. Confidence and determination matter. But treating them as sufficient conditions rather than necessary ones shifts blame for systemic problems onto individuals. Compare this to Nordic countries, where stronger social safety nets, lower inequality, and different cultural narratives produce measurably different behavior. Lottery participation is lower. Pyramid schemes find fewer victims. This isn't because Norwegians or Danes have different brains. They face the same biological vulnerabilities, but they operate in systems where the gap between ordinary life and prosperity is smaller, where healthcare and education don't require gambling your future, where failure doesn't mean catastrophe. The desperate optimism that makes people vulnerable to schemes is partly a rational response to systems that offer few legitimate pathways to security. Asian cultures face different but related pressures. Filial piety creates obligations to support parents and extended family. This can create enormous pressure to find high returns quickly. A young professional in Shanghai might feel responsible for parents' retirement, siblings' education, and eventual support of children, all on a salary that barely covers their own expenses. Get-rich-quick schemes become attractive not from greed, but from impossible obligations. The family structure that provides social support also creates vulnerability to schemes promising rapid wealth. The philosopher Max Weber traced connections between Protestant work ethic and capitalism's development. He argued that certain religious frameworks created cultural dispositions toward accumulation and reinvestment. What he couldn't foresee was how, in late capitalism, the ethic would persist while the promise evaporated. You're still supposed to work hard, save, invest, but the returns don't materialize. This creates a crisis of meaning. If you've done everything right and still can't achieve security, The problem must be either the system or you. Acknowledging systemic failure feels overwhelming and offers no individual solution. Blaming yourself feels terrible, but preserves the belief that things are within your control. Get-rich-quick schemes offer a third option, a way to work within the system, but bypass its normal rules. This economic context creates the audience, but there's a final ingredient in the recipe for delusion. Even when people understand the odds, even when they can articulate the risks, even when part of them knows better, they proceed anyway. This requires examining the internal psychological mechanisms that allow intelligent people to maintain beliefs they would recognize as irrational in others. Cognitive dissonance describes the discomfort of holding contradictory beliefs simultaneously. Your mind seeks resolution. If you've invested in a scheme and evidence emerges that it's fraudulent, you face a choice: admit you made a mistake and accept the loss, or find ways to discount the evidence and maintain the belief. Admitting mistake means confronting feelings of foolishness, wasted money, and damaged self-image. Maintaining belief allows you to avoid those feelings, at least temporarily. The longer you've been invested, the higher the cost of admission, so the more motivated you become to rationalize. Multi-level marketing demonstrates this beautifully. The average participant loses money. This is statistically documented. Yet many who lose money continue participating and even recruit others. This seems inexplicable until you understand identity fusion. The MLM doesn't just become something you do, it becomes who you are. You're not a teacher who sells supplements on the side. You're a health entrepreneur building a business. Your upline becomes your mentor and friend. Your downline becomes your team and responsibility. Your social media becomes a stream of testimonials and product promotions. Your identity has merged with the scheme. Leaving means losing not just money, but community, purpose, and sense of self. Public commitment amplifies this. Once you've told everyone you're doing this, once you've posted about it, once you've tried to recruit your friends, backing out means public humiliation. You've staked your credibility on the enterprise. Social media makes this permanent and visible. Your posts claiming this will change your life remain in your history. Every interaction based on the scheme becomes evidence you have to explain or justify. The psychological cost of exit increases with every public statement of commitment. The illusion of control plays a crucial role. Humans are pattern-seeking creatures. We see faces in clouds, meaning in randomness, signals in noise. Traders looking at charts convince themselves they see predictive patterns. Gamblers develop systems. Day traders believe they have insights, others lack. Studies show that 97% of day traders lose money over time, yet the practice continues and even grows. This isn't ignorance. Many day traders know the statistics, but they believe they're in the 3% who succeed. This belief isn't based on evidence. It's based on the need to believe you have control. The Dunning-Kruger effect explains part of this. People with limited knowledge in a domain overestimate their competence. Beginners don't know enough to recognize what they don't know. A few lucky early trades convince them they have talent. By the time they've lost enough money to realize their ignorance, they're committed. The sunk cost fallacy takes over. They've invested money, time, and ego. Quitting means admitting it was all wasted. So they continue, telling themselves they're learning, they're getting better. The next trade will turn things around. Confabulation describes how we create narratives to explain outcomes. If you make money on a trade, you tell yourself it's because of your analysis. If you lose money, it was bad luck or unforeseen circumstances. You remember your wins vividly and forget your losses, or remember them differently. Your internal narrative becomes a highlight reel that confirms your skill. Research on memory shows we don't store experiences accurately. We reconstruct them each time we remember, and we reconstruct them in ways that protect our self-concept. Counterfactual thinking, the if-only thoughts, can either help or trap you. If you sold a stock and it subsequently rose, you torture yourself with what could have been. This makes you more likely to hold too long next time. If you held and it fell, you imagine how you would have timed it perfectly. These imaginary alternative scenarios don't provide useful information, but they feel like they do. They maintain the belief that success was possible, that you were close, that you just need to adjust slightly. The redemption narrative is particularly powerful. This next scheme will make back everything you lost on the last one. You're not gambling, you're recovering. This framing allows behavior that would otherwise feel reckless to feel responsible. People who've lost money to one scheme become the best targets for the next one, not because they're stupid, but because they're desperate to repair the damage. Each loss creates vulnerability to the next promise. Online communities can reinforce or challenge these delusions depending on their composition. Forums dedicated to day trading or cryptocurrency or MLMs become echo chambers where losses are minimized and successes are celebrated. Members support each other's delusions because they share them. Challenging the premise would mean challenging your own choices. These communities develop their own language, in-group signals, and shared enemies. Regulators become obstacles. Traditional investors become dinosaurs. Critics become haters. This framework makes the community resilient to outside information and creates strong social bonds based on shared belief. Shame prevents exit as powerfully as anything else. Admitting you fell for a scheme means admitting vulnerability, foolishness, and failure. These are deeply uncomfortable acknowledgments. They're especially difficult for people who pride themselves on intelligence or savvy. The smarter you think you are, the harder it is to admit you were conned. So people remain in schemes long past the point where evidence has become overwhelming, not from stupidity but from an inability to face what leaving would mean about them. The philosopher Jean-Paul Sartre wrote about bad faith, the way we lie to ourselves to avoid uncomfortable truths about our freedom and responsibility. Financial delusion operates in this space. Some part of you knows the truth. The returns are too good. The explanation doesn't make sense. The statistics are clear, but acknowledging this truth would require action you don't want to take. So you construct elaborate justifications for why your case is different, why the rules don't apply, why this time will work. This isn't conscious deception. It's a subtle process of selective attention, motivated reasoning, and narrative construction that happens largely below awareness. Understanding these psychological mechanisms is illuminating, but it raises an urgent practical question. If we're all vulnerable, if the schemes are sophisticated, if the systems amplify desperation, what actually protects people? What can we do individually and collectively to resist? The ancient Greeks understood something relevant. In Homer's Odyssey, Odysseus must sail past the sirens, creatures whose song drives men mad with desire and lures them to destruction. Odysseus wants to hear the song but knows he cannot trust himself to resist. His solution is a pre-commitment device. He has his crew tie him to the mast and plug their own ears with wax. He orders them to ignore his commands, while under the siren's influence, when the song comes and he struggles to break free, the ropes hold. He hears the beauty, but survives the danger. Pre-commitment devices work for financial decisions too. Automated retirement contributions deduct before you can spend the money. Cooling-off periods for major purchases create delay between desire and action. Some people give trusted friends permission to challenge financial decisions. Others set rules like never investing money they can't afford to lose or always sleeping on any decision over a certain amount. These tactics acknowledge that you won't always be rational in the moment. They create barriers between impulse and action. The 10-10-10 rule asks you to consider how you'll feel about a decision in 10 minutes, 10 months, and 10 years. This creates temporal distance that can cut through the intensity of immediate emotion. In 10 minutes, you might still feel excited. In 10 months, will you be glad you did this? In 10 years, will you view this as wise or foolish? The longer timescales activate different thinking processes, more deliberative and less impulsive. Mental accounting, treating different money differently, can help even though it's economically irrational. Money is fungible, but psychologically, labeling money for specific purposes creates barriers to spending it frivolously. An emergency fund feels different from mad money, even if they're in the same bank. This irrationality protects against other forms of irrationality. Awareness of emotional states matters. Studies show people make different decisions when they're hungry, tired, stressed, or horny. Knowing this doesn't eliminate the effect, but it can prompt caution. Maybe don't make major financial decisions after a bad day at work or when you're feeling desperate. Maybe have rules about not acting on investment impulses late at night. Simple awareness that your state affects your judgment can create enough pause to reconsider. They place the entire burden on the person to protect themselves from sophisticated exploitation. This is like trying to prevent drunk driving purely through personal responsibility, while allowing unlimited alcohol, advertising, and no regulations on bars. It might help on the margin, but it can't solve the systemic problem. But knowledge doesn't reliably change behavior. People who can correctly answer questions about probability still play the lottery. The problem isn't information, it's psychology, and psychology doesn't respond to information alone. Opt-out retirement savings, where you have to actively choose not to participate rather than actively choose to participate, dramatically increases participation. This works because inertia is powerful. The default matters enormously. Countries with opt-out organ donation have much higher rates than countries with opt-in, even though both systems allow the same choice. The framing changes behavior. Requirements that certain contracts allow cancellation within a period create space for reflection. The urgency tactics that schemes rely on lose effectiveness when people have time to reconsider. Disclosure requirements, when well designed, can help. Making fees and risks explicit and prominent makes them harder to ignore. The key is that disclosure must be genuinely clear, not buried in dense legal language designed to obscure. When regulators actively investigate and shut down schemes early, fewer people lose money. When penalties are serious, the risk-reward calculus for scammers changes. When media outlets have resources for investigative journalism, scams get exposed before they scale. These are all collective choices about how much protection to build into the system versus how much responsibility to place on individuals. Social media amplifies scams. Algorithms optimized for engagement promote content that generates emotion. And get-rich-quick promises generate powerful emotions. Platforms could do more to detect and limit scam content, but there's tension between this and growth. Every barrier to scams is also a barrier to legitimate content. Finding the balance requires values choices about what platforms optimize for. If you didn't know whether you'd be smart or gullible, rich or poor, educated or not, what rules would you want? Probably stronger protections than we currently have. Probably more aggressive regulation of schemes that primarily transfer wealth from the vulnerable to the clever. This framework suggests that allowing scams to proliferate in the name of freedom or personal responsibility is actually unjust. And maybe that desire isn't entirely bad. Maybe the problem isn't wanting life to improve. It's the method and the timescale. Market movements, other people's decisions, lottery numbers, these are outside your control. Worrying about them or trying to manipulate them leads to suffering. What you can control is your effort, your choices, your responses. This framework doesn't promise wealth. It promises peace through accepting what you can and cannot influence. Lottery winners return to baseline happiness within a year or two. So do accident victims who become paraplegic. We're remarkably good at adapting to our circumstances. This suggests that sudden wealth, even if you achieved it, wouldn't bring the lasting transformation you imagine. The hedonic treadmill continues regardless. This isn't an argument against improving your life. It's an argument that the mechanism matters more than the outcome. Denmark consistently ranks among the world's happiest countries, despite not having the highest GDP. The concept of hygge, roughly translated as cozy contentment, represents a value system that emphasizes comfort, connection, and modest pleasures over ambition and acquisition. Bhutan famously measures gross national happiness alongside economic indicators. These aren't perfect systems, and they have their own problems, but they demonstrate that prosperity can be defined differently than maximum wealth accumulation. Compound interest works, but it works gradually over decades. A 7% return doubles your money in 10 years. That's not exciting. You won't quit your job, but it's real and it compounds. The boring investments, the index funds, the diversified portfolios, these don't promise transformation. They promise incremental improvement. For people in desperate circumstances, incremental isn't enough, which brings us back to the systemic issues. But for those with some stability, rejecting get-rich-quick might mean accepting get-rich-low or get-stable-slow. Credit unions are owned by members and return profits to them. Mutual aid societies pool resources to help members in need. Cooperatives distribute ownership and decision-making. These models won't make you rich quickly, but they build collective resilience. They represent different assumptions about how economy and society should work. They're not schemes promising impossible returns. They're structures acknowledging interdependence. The challenge is that accepting slow, stable progress feels like giving up on dreams. Our culture valorizes ambition. We celebrate the big win, not the consistent effort. Rejecting get-rich-quick schemes means accepting that you probably won't have the dramatic transformation story. Your life might improve incrementally. You might retire comfortably, but not luxuriously. You might achieve security, but not wealth. For many people, that feels like failure. But it's actually success as defined by what's achievable for most people most of the time. The question isn't whether you'll be tempted. You will be. Your brain is wired for it. The systems you live in amplify it. The schemes will be sophisticated and emotionally compelling. The question is whether you'll recognize the moment when it arrives, whether you'll notice the feeling of certainty, the sense that the normal rules don't apply, the conviction that this time is different, whether you'll pause and ask uncomfortable questions instead of rushing forward. We're all trying to build better lives. That impulse is human and healthy. The tragedy is when the method undermines the goal, when the pursuit of security creates catastrophe, when hope becomes the weapon used against us. Understanding why we chase get-rich-quick schemes won't eliminate the temptation, but it might create the pause needed to choose differently. It might help us direct that powerful optimism and desire for transformation toward things that actually work, slowly and unglamorously, over time. The tulip merchants of 1637, Isaac Newton in 1720, the Russian grandmothers of the 1990s, the NFT traders of 2021, they all faced the same choice. They all felt the same certainty. Most chose to believe. The evidence was always there. The patterns were always visible. But patterns only protect you if you recognize them in the moment, not just in retrospect. That recognition, that pause, that willingness to question your own certainty, even when it feels completely justified. That might be the only real protection any of us has. Not immunity from temptation, but the capacity to notice it and choose differently. Knowing that the boring path you reject might be the one that actually gets you where you want to go.